Ladies and gentlemen, good day and welcome to Q4 and FY'24 earnings conference call of Khadim India Limited, hosted by Orient Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sumit Ketan from Orient Capital. Thank you, and over to you, sir.
Thank you, Aditya. Good evening, everyone. Welcome to the conference call of Khadim India Limited. Today from the management, we have Mr. Ritik Roy Burman, Whole-Time Director, and Mr. Indrajit Chaudhary, CFO. Before we start the call, I would like to give a small disclaimer that this conference call may contain certain forward-looking statements which are based on beliefs, opinions, and expectations of the company as on date. Actual results may differ materially. A detailed safe harbor statement has also been published on the company's investor presentation, which was uploaded on the stock exchange today. I hope everyone had a chance to go through the results and presentation before this call. I would now like to hand over the call to the management for their opening remarks. Over to you, sir.
Yeah, thank you. Good evening, everyone. Good evening, everyone. On behalf of Khadim India Limited, it is my pleasure to welcome you all to this conference call to discuss the Q4 and FY'24 results. We appreciate your time and interest in our company's performance. I hope that everyone had an opportunity to go through the financial results and investor presentation which have been uploaded on the stock exchange. The global economic environment has been challenging, with inflationary pressures and changes in consumer spending behavior impacting our sales this quarter. Additionally, demand continues to remain weak in Q4. Despite these challenges, we managed to maintain our margins, which stood at 46.2% for the quarter, an increase of 180 basis points, and 45.4% for the full year, an improvement of 350 basis points year over year. Looking ahead, we expect our margins to improve with the softening of key raw material prices. Retail sales contributed 61% in Q4 FY'24 and 65% for the full fiscal year. During the year, we added 94 stores, bringing our total count to 868 stores in FY'24. Breaking it down by model, our CEO store count stands at 223 stores, company-owned outlets, while the franchisee model has 645 stores. Our distribution business contributed 35% to revenues in Q4 and 31% for the whole FY'24. Our distribution network includes 753 distributors with an addition of 81 distributors this year. The East Zone remains particularly strong with 482 distributors. Our retail and distribution business are present in 27 states and 5 union territories as of FY'24. We are closely monitoring the market situation regarding BIS regulations on various footwear categories, and our demerger process is on track, and we are awaiting approvals from regulatory bodies. We are confident in our long-term strategy to return to growth and deliver value to our shareholders. We believe in the strength of our brand, the loyalty of our customers, and the potential for growth in the footwear market. Now moving on to Q4 and FY'24 financial highlights. Firstly, quarterly performance. On quarterly performance, revenue from operations Q4 FY'24 stood at rupees 143.6 crores as against 159.2 crores same period last year, down by 9.8% year on year. Gross margin for the quarter stood at 46.2%, up by 180 basis points year on year, as higher contribution from retail led to favorable product mix. The EBITDA for the quarter stood at 16.8 crores, registering a growth of 2.6% year on year. Operating EBITDA margin for the quarter stood at 11.7%, up by 140 basis points year-on-year. The net profit for the quarter stood at rupees 1.05 crores, down by 75.5% year-on-year. PAT margins were 0.7% down by 200 basis points year-on-year. Now on to the financial year 24 financial highlights. Revenues for operations for FY'24 stood at 614.9 crores as against rupees 660.3 crores in FY'23, a decrease of 6.9% year-on-year. Gross margin for FY'24 stood at 45.4%, up by 350 basis points year-on-year. EBITDA for FY'24 stood at rupees 71 crores as against 72.5 crores in FY'23, a degrowth of 2.1% year-on-year. EBITDA margin for FY'24 stood at 11.5%, up by 50 basis points year-on-year. Profit after tax 3 crores for FY'24 versus rupees 17.5 crores in FY'23, a decrease of 63.9% year-on-year. PAT margins for FY'24 stood at 1%, down by 170 basis points year-on-year. We appreciate your ongoing support and confidence that our proactive approach will yield positive results in the coming quarters. With this, I conclude my speech and open the forum for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Deep Shankar from Trustline PMS. Please go ahead, sir.
Hi, this is Deepan Shankar here. Good evening, everyone, and thanks a lot for the opportunity. And congratulations for good retail performance. So, firstly, my side, so how do we see footwear demand improving for FY'25 on this background of this BIS implementation? We have seen many of the footwear peers also has reported drop in revenues growth. So how do we see demand improving in FY'25?
In regard to demand in retail, it is muted still. There are 2-3 reasons for that. One is the macroeconomic condition. Another is that we are basically in the eastern part of the country, where in the month of April there was a continuous period of heat wave going, which has really restricted the footfall in the stores. Second, there is a month-long basis process of votes going on throughout the country, which has also hindered the sales. So basically, there is a demand mutedness in the market for retail sector.
Okay. So do we expect this flattish kind of run rate to continue in FY'25 also, even for industry?
I think after the election is over, I think some amount of demand will come back, that is expected. And also in the festive season, the demand comes back, that is there. But during the year, after this lull period for a long time, I think the macroeconomic condition for footwear will improve and some demand will come back.
Okay. So have we taken any price hike during the quarter?
We have not taken any price hike because since the demand is muted, again taking a price hike may also impact the volume. So we have kept the price. We have changed some products. A new product has come in AW when the festive thing with a new price range. But
Okay.
basically the older product, which are running product, we have not taken a price hike, seeing the lull in the demand and the volume degrowth. So we have kept the price for the running product intact.
Okay. So what is the kind of numbers we have seen in cocoa and franchisee stores in retail?
For which period?
So for last quarter, Q4.
In the fourth quarter. So we have around 93 crore sale in the franchise retail and around 50 crore in distribution.
Okay. And this drop in distribution business seems very high. So have we consciously reduced any product categories, or we have cut shorted any region specific to improve margin?
Yes, we margin in distribution as because I think from last year we have the sale has reduced around 30 crores in distribution. This is a genuine call taken by us to reduce our receivables also. But this year, I think the product category also changed. We have introduced new product, and in the distribution, the product is in demand. So I think this year we will be able to do a sales of what we have done in the FY'23, and I think this loss of distribution will drastically come down.
Okay. Okay. Thanks a lot and all the best. I'll join back with you.
Thank you.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and 1 to ask questions. Our next question is from the line of Abhishek from Alpha Investco. Please go ahead, sir.
Thanks for the opportunity, sir. And it's heartening to see good performance in retail division and also the bounce back in distribution margins. So my question was regarding sports and athleisure. So how has we understand that there's 18 to 20% contribution from this segment. So can you talk more on this, how it did in Q4, and what are the new designs we are introducing, or the SKUs, or anything on casual wear also?
Hi. So sports and athleisure remains to be a good contributor. I mean, the ladies sports shoes category has also done very, very well. The boys sports shoe has also done very, very well if we compare on a year-on-year basis. So, we are launching a lot of designs in every kind of, sports shoes also has different kind of price points, right? Some like below 1,000, some like 1,000 to 1,499, and 1,499 to 2,000. So there are lots of price brackets. So we are keeping products in each of these price brackets so that none of the athleisure and sports consumers are going away from us. Also, we are very shortly going to launch the athleisure wear, I mean the garments, athletic wear type of product, gym wear, etc. under our sub-brand Pro. So that also should give us some, addition in sales. So this is how we are working on our sports shoes brand. Like I said, ladies sports shoes, boys sports shoes. Then sports shoes store was doing well only from last year onwards. But after launching good designs in ladies and boys, girls and kids also, those are also doing pretty well. So we are focusing on sports shoes in that way.
Yeah, understood, sir. So can you say how much will we contribute from athleisure wear in FY'25? What type of business are we looking at?
We are mainly the garments athleisure. We are launching in some of our top cocoa and in the franchisee. It is a test case study we will do.
It's too early to comment how much percentage will that be of the sales. But we have kept the prices very attractive in the athleisure wear category. So we hope that people will like it. We have shown our franchisees also and most of them look very energetic after seeing that you all are coming into some clothes also. So that way we are optimistic, but it's too early to comment that how much percentage will that be out of the total turnover.
Because our store size are not very high store size. So where we have space, we can utilize. So we are implementing, I think, on 20 COCO outlets and around 20 franchisee at the initial stage. Then if it clicks, then we will go and spread it more.
Okay, so Q1 we've already implemented this. We've already started to roll out. In Q1 we've already started to roll out.
No, it will be rolled out in July.
Yeah.
If we are ready with the product, it will be implemented in July.
Q2 onwards.
Q2 onwards.
Q2 onwards. Okay. And what are sort of the price range for this?
It's a very lucrative price around, I think,
500.
500 to 750.
500 to 750, yeah.
Oh, okay. That's very attractive price.
Shirts, polo t-shirts, all these things.
Understood. So recently we've seen that you've been renovating a lot of stores and a lot of new store openings also. So what sort of volume growth do we see in FY'25 or any SSG metrics if you can provide for FY'25?
We will be opening around 25 COCO and around 70 franchisee. So we expect in our value terms around 6 to 7% growth from this expansion.
6 to 7%. Okay. And anything on the margin side for FY'25?
Margin will remain more or less same because
16, 17.
we are not taking any price hike. We want to increase the volume, so that's why we are keeping. In some new product has been launched with generally in the same margin range.
Understood. So what was our ASPs for FY'24?
ASPs for retail it's around 539.
Okay, so that's higher than FY'23. Is it right?
528 was FY'23 and FY'24 is 539.
Understood. Even in a lull market, they've grown the ASP. Okay. So any updates on the demerger side? Should we expect completion of demerger in this financial year?
We have received approval from the BSE NSE and now the matter is presently pending with NCLT. So another 3 to 4 months it will take to get the demerger order.
Okay. And complete listing of demerged entity?
Yes.
In 3 months?
3 to 4 months depending on the NCLT order.
Okay. Okay. Thank you, sir.
Thank you.
Thank you. Our next question is from the line of Chirag Shah from White Pine Investment Management Private Limited. Please go ahead, sir.
Hello.
Yes, sir.
Hello. Yeah, I hope I'm audible.
Yes, sir.
Yeah. Yes, sir. Thanks for this opportunity. Sir, so first very basic question. BIS has been implemented, right?
Yes.
And now that we are into 4-5 months of implementation, I presume the excess inventory which was people had hoarded on in November, December would have been consumed at industry level. Is it the right assumption to look, or there is still inventory lying in the system? Because that would have affected our performance in Q4. So April, May, how it has been for us?
No, BIS inventory, there has been time given to liquidate the stock also. So most of the stocks have been sold. Some stocks are there. That is also we are trying to sell it out. And discounts are given during the US season.
Okay, so you are saying even April, May, that issue of inventory, pre-BIS inventory was there in the system. And I presume when you say you refer to your performance, it would be similar for the industry also.
Because you cannot in within 3 to 4 months you cannot liquidate all the stock that you are holding in the month of December.
Okay.
And they have given a a timeline, like before that time, whatever stock you have, that you don't need to worry about that. But whatever is being produced after that time, there you have to implement the BIS. And for some small and micro industries, they have given further extension for some more time.
Okay. So, in your best assessment, by when this BIS inventory issue, pre-BIS inventory issue gets out of the system, what is your best assessment or best estimate about that? Another 2-3 months or another 1-2 months, or it could take longer?
Because what happens that some inventory that are not sold get stuck. So
that's okay. That's kind of dead stock. I'm not even referring to that. So in general, you are saying that stocking which was done before BIS, because there were good amount of imports also which had happened. So that all has been kind of now getting addressed in last 5 months. That is a fair way to look at it?
Yes. But they have also now, they have implemented the BIS in a mixed way, because what product they have implemented means for micro and small, there is no BIS regulation right now. It has been shifted to
for a year.
For a year. So that when it comes again, there will be some stock which will be pre-BIS. So that again will be liquidated when comes within the orbit.
I mean, we are continuing to produce because we are almost ready with whatever the BIS parameters were, and we are making products already. So we are continuing making the products in BIS standards only. However, there has been an extension for a year for the smaller factories. So there shouldn't be a problem for some time.
So that is 5 crores, right? That small and micro classification is up to 5 crores of annual revenue.
Yeah.
Okay. So that was one. So second, you were very focused on increasing the share of pro/premium products. If I recollect the memory, it was around 20% for us last year. So where is that percentage would have gone up this time in last 1 year?
For pro or what?
For both. Right. Pro as well as overall, whatever you classify as premium in terms of pricing, because your price ladder starts from very, very low and entry level, right? So whatever you internally classify apart from pro as premium, just wanted to know.
When the whole sports shoes category comes, it would be around 10 to 12% of our total contribution. But under the pro brand, there are other things also. There is sports shoes. Then there is some these what you call that floaters are also there. So pro as a brand would be 17 to 20%, but sports shoe would be around this 10 to 12%. And like I said previously also, ladies sports shoe has grown very handsomely. Kids sports shoes and boys sports shoes have also done very well. So, and premium price points are also doing better than like I have said in previous calls and some other places also, that premium price points are doing much better than the below 1,000 price points at the moment. Like above 1,400 का जो भी हम लोगों का प्रोडक्ट्स है, वो सब में अगर हम लोग लास्ट ईयर से कंपेयर करें तो सभी में there has been growth above 1,000, above 1,400. This 2,000 to 2,499, we have these British Walker, the shoes, leather premium shoes. That has also seen a very handsome growth for us.
The sub-brands last year was around 67%, and this year it is around 59%.
Sub-brand which was 59%, and that would be largely because of this premium. So that is percentage. I was more focused on growth. So this premium brands would have grown by what, 5-7% for you, or it would be lower?
One figure like this 2,500 to 2,999. it's a bit hard to comment on exactly how much percentage it has grown, but the turnover is almost like 2,500 to 2,999, the products that we sell, which would mainly constitute the British Walker, leather shoes and some sport shoes also high-end. That turnover has become almost double from what it was last year. Last year we didn't have only in this high price range. So that turnover has almost become double. And then 1,500 to 1,999, which constitutes of lot of ladies premium type of sandals, chappals. Then there are some formal shoes also. That has also gone up, 8 to 9% that has gone up. But what needs to be kept in mind, the lower price points have gone down more. They have gone down quite a bit. So we have to tackle both these. We cannot.
Last year we have sold around 228 crores. This year we have sold sub-brand around 230 crores. But since the retail sale has gone down and it is mainly in the Khadim category, so overall the sales impact has not come in totality. However, the sub-brands, the higher price point increase more compared to the degrowth that has happened in the lower price point.
No, this is helpful. And sir, are you internally rethinking the strategy of the lower end? I know your earlier strategy was to focus on volumes also, which is required. But if you take a slightly longer period, because this pain period has been very long in general, and it appears at every level or sub-level there is premiumization. Is there a thought to or cut down the entry points and focus more on so-called premiumization? Because if entry points is not bringing in profitability, or you may be making some losses at current level, or higher losses than the average performance, doesn't it make sense for you to focus your energy in trying to premiumize yourself?
No, here I said they are not making any losses, but the growth in the lower segment is not coming because what has happened when we took the price hike, we have taken price hike in the lower point also. So that has decreased the volume compared to the other ones when we used to sell more volume. So what we are thinking, maybe in this means the lower segment, we may little bit cut down the prices and bring back the volume so that the overall sales of the company increases. Sub-brand will keep like that. We'll come out with new design with the higher ASP and the higher margin. But in the lower segment where we used to get higher volume, to get back the volume, we may reduce some. That is a strategy that is not finalized, but we may take some strategy in the lower price point. Because we have in the tier 3, tier 4, and we have our franchisee who also, because they also dependent on the Khadim brand on the lower segment. So for them to survive also, we have to think in different way.
Yeah,
sorry to interrupt, sir.
It might have grown.
Hello, sir. Sorry to interrupt, sir.
Hello?
Yes, sir. Sir, should you return to the question queue? Because several participants are waiting for their turn, sir.
Okay.
Thank you. Our next question is from the line of Uday Kumar from SMIFS. Please go ahead, sir.
Yeah, hello. Thank you for taking my question, sir. So just to follow up on the premiumization trend, your share on the premiumization is around 6%. So any plan to increase the share overall, and how we are seeing this going forward?
Can you come back once more?
Sir, hello, am I audible?
Yes, you are audible.
Sir, our premiumization share is around 6% right now. So are we planning to increase the share, or what are we planning to increase the share, and how are we going about this in going future?
Premiumization
sale is not 6%.
Premiumization, we sell sub-brand of around 59%.
Yeah.
Premium, it's the MRP at retail stores. It's footwear market segmentation in your slide. It's around 6%. Over 3,000 rupees MRP.
Okay.
Okay. Yeah.
So, see, we have sub-brands in British Walker. We have around 3,000, so more than 3,000. Yes, in some store we'll bring up some prices more, but mainly our main sale comes from tier 3, tier 2. So where we sell less than 1,000 also. So we have to focus on that also. Maybe in the cocoa where we are in the urban city, we will come up with the higher prices sub-brands.
Yeah.
So then the athleisure one which you are opening right now will be for the mass market, not for the premium one.
Which one?
Athleisure.
The athleisure is for the shops in the urban market and the shops which have the capacity to hold that athleisure product. We have a space only in that to keep the athleisure.
And then there's just a margin thing, sir. Any margin guidance for the athleisure one? Will it be higher or will it be the same for the athleisure one?
No, we are the margin will be lower than what we have in the footwear, but we have kept it as a test check. If it perform well, then we'll decide on the better margin.
Yeah. Okay. Thank you for taking the question.
Thank you. Our next question is from the line of Anshul Segal from Segal Capital. Please go ahead, sir.
Thanks for taking my question. I noticed that our cocoa has been going down and franchise has been going up over the last few years as a proportion of sales. Does this mean that there is going to be, if this trend continues, there is going to be upside to margins going forward? As also there will be an improvement in working capital as we move ahead?
No, we sell around in gross numbers, the cocoa sales around 300 crores average, and in franchisee we sell around 200 crores. So we open around 70 franchisee and we will be opening 25 cocos. So the ratio would be around 60-40 ratio will continue.
So the ratio won't change. It will remain in the 60-40 going forward. Even though in the last few years, if I see your presentation, we were at 61% in cocoa and that's come down to 56% today.
56 because this year the cocoa has not grown because we have the number of stores opened in cocoa is less compared to the franchisee. But in the year to come, it will be in the range of 60-40.
60-40, okay. And what will be the impact on margins and also working capital as a result?
No, margin will remain the same what we have, maybe some basis point here and there. And the working capital will remain at the same level what is, we'll definitely try to reduce the inventory days and the debtors days. But it will be because the ratio remains the same, so working capital also remains the same.
Okay. In your opening comments, you said that because the last few years there has been weak demand, this year you anticipate sometime in the middle of the year for demand to pick up. Is that simple mean reversion or there is something that is changing on the ground which you anticipate will give tailwinds to demand?
The demand is there when the festive comes. Both we have seen in FY'23 also when during
Eid also there.
Eid in this festive time the demand come back. But what has happened is that during the non-festive time, the demand is not there. But in the last 2 months, we are seeing a lull in the retail segment. So with the election is over and with the money flowing back in the system, I think the demand coming back. That is the assumption of the entire footwear industry.
Right. If we take a slightly longer term view, say 3 to 5 years, our retail business, I think, is about 500 crores today. Where do you see a retail business being in, say, 3 years from now?
We have an annual growth plan of around 12 to 15% in the retail segment, and we are having an EBITDA margin of around 16 to 17%. So with the growth coming back in the retail, we expect to be around 650 to 700 crores in retail and EBITDA margin of around 17 to 18%.
This is in the next 3 years is what you're suggesting?
Yes.
Or even earlier?
As we were earlier.
Okay. The gross margin expansion in the current year, has that been largely due to the mix change?
Yes.
What you were just suggesting.
Some ASP growth also.
Some ASP growth in the premium products is what you're saying?
Yes.
Okay. And my final question, you said that you may look to reduce the prices of the lower-end products to bring in volumes. Is there, so what that indicates is that there is demand in the market at the right price. And our prices are slightly higher than that balance, which is why demand is not coming in. Is that a fair assessment?
See, that is the assumption because in the price point what I am referring, there are lots of unorganized players also. So maybe some part of the demand has gone to the unorganized sector because with the COVID and people in the lower segment and the middle segment has changed their footwear from organized to unorganized due to price. So that may be impact, and we are seeing the demand in our franchisee and in the tier 3 and tier 4 cities has gone down drastically. So in order to protect their sales also, we may think we are not yet planned, but we are thinking, we are taking a market research. We are going to the consumer and having a feedback from them. Based on that, let the data come, then we will take a decision on the price point of the lower segment because that is a good amount of pie in our total sale.
How much would that be, just for our assessment?
Within 500, we are having around 25% of the sales.
Okay. Despite this, given that our target is to reach, say, 16-17% EBITDA margin in the next 3 years, despite this price decline, you expect that this year we will see a margin uptick?
Definitely, if the sales improve, because you see with the degrowth in sale, our EBITDA margin has increased from 11 to 11.5% in a company level. So definitely with the sales growth coming, will definitely improve the margin by 100 basis points.
Sounds good. Thank you very much.
Thank you. Our next question is from the line of Chirag Shah from White Pine Investment Management Private Limited. Please go ahead, sir.
Yeah, thanks for the opportunity again. Sir, speaking back to the premiumization trend, so you indicated you are seeing growth. Now, I had a slightly different question. If you do a geographical split of this growth, is it coming across the country or it is coming from certain regions? And if you can just highlight which region is seeing higher growth, because, yeah, that is the question. Then I'll come to the next part.
The growth is generally predominantly throughout the zone, but since our main base is in the eastern part of the country, so the bulk growth is coming from the east only.
Okay, so the revenue mix would be similar, right? It is not like only east is seeing growth in the premium portfolio and other parts of the country, south or where it is you are not able to grow your premium portfolio that aggressively.
That's not an issue.
That's not an issue.
Premium is same everywhere. Yeah.
It's same everywhere.
East is not premium wise also it's growing, and otherwise east sale is comparatively much better. It's not degrown that much. It's almost similar actually, east sales.
And the second question was, you are looking to deploy the recent capital raised in refurbishing the stores. So if you can highlight where are we in that journey and how are you looking to deploy over how many years or how much time frame?
This is mainly we will refurbish the store and also for the expansion fund that has been taken. And mainly the store we have planned for the next 2 years to open store in the eastern part so that the profitability comes within the year. And also refurbishing of the store, we have taken out where the EBITDA of that store is high and where the renovation is not done for say 7 or more years. We are doing the refurbishing in that stores only so that the revenue can be improved fast.
Okay. And you have identified how many stores are required to this required this refurbishing?
Around 22 stores would be refurbished this year.
In overall scheme of things, it would be like a count of 100 stores that would require refurbishing, or it's only 50-60 stores that require refurbishing?
No, refurbishing around, because during the COVID time we have not refurbished. So out of say 100 stores that require, because there are stores which require partial renovation also.
Okay.
So I think around 60-70 require full renovation, 30 require partial. So out of the 70 we are renovating 22.
22 this year. And on the expansion side, what you indicated, 25 Coco, that is where the capital will get deployed, right?
Yes.
That is how we should look at it.
Yes, yes.
Okay. And generally, would it be right to assume that once you refurbish the store, 3 months down the line, you start seeing the results? Is it a fair assumption, assuming demand is stable?
Yeah. Yes, yes.
Yeah.
And this refurbishment will take what, 2-3 months, or it will take a bit longer, given some of them are 6-7 year old?
We have done, we have refurbishing also, we have planned in quarter way. So we will see in first quarter we will do around 8 refurbishing, see what is the impact of the refurbishing. Then again we will go for another 8. So we will, during the out of 22, for the first 2 quarter we will do 16. And then we'll check the market, how it's doing. Then we'll go for the next 6.
Okay. This is helpful. So hopefully in second half onwards, all the tailwinds start playing out for you, right? From demand till the benefits of refurbishing. So that is how one should look at FY'25. Would it be fair assessment?
Yes, yes.
Okay, great. Thank you very much and all the best.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question for the day. I now hand the conference over to management for closing comments.
So I thank all the investors for joining our Concall. We are really working hard to to give our offerings once the demand scenario improves. We are getting ready with all the things that are necessary, and hopefully we'll be in good growth numbers in the coming times. Thank you.
Thank you.
Thank you. On behalf of Khadim India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.